I'm having a hard time wrapping my mind around the value of money in the stock market, especially in today's environment. And so it just seems like the price of a lot of stocks is completely irrelevant to the company's earnings. And so my question is, if my money is more effective in real estate than it is in the stock market, since if I buy a rental property, for example, it actually generates cash, whereas the only value that you get from a stock is whenever you sell it, and if somebody wants that particular certificate of stock.
Well, or if you buy a dividend-paying stock, which I don't buy single stocks anyway, but we can discuss the philosophy or the concepts behind it. Generally speaking, you would make a lot, if you do a good job with it, you would make a lot more rate of return on real estate. But it involves more hassle, more of your time. Even if you hire a management company or whatever, you've still got more time than just buying a mutual fund and throwing it in the drawer and forget it. Okay, and you get the statements on your email, once a quarter, once a month, or whatever. You have zero hassle factor buying a mutual fund or buying stocks, unless you're going to try to buy and sell them, which I would never recommend. But a buy and hold strategy on real estate, while it generates cash flow, it should outperform stocks, but it has more hassle. It outperforms mainly because it's an imperfect market in terms of, that's an economic term you may be familiar with. A perfect market is one where all buyers and sellers have exactly the same information and the exact same access to buy. And so the stock market is closer to a perfect market than real estate. Real estate, each item is unique. It's unique to a certain area, and all buyers and sellers never have even close to the same amount of information or belief about a piece of real estate. And so real estate gives you a lot more opportunity to get a bargain, in other words, and if you're willing to invest the time, you should make more on it. Real estate creates three types of return. One is, as you said, increase in value, and cash flow is 2, which is the rental income on it. And 3 is you get to depreciate it. So you actually get a tax break that covers a portion or all of your rent that comes in, and that actually has a cash value to it. So when you put those 3 together, that's called an internal rate of return. Have you ever heard that?
Yes.
Okay. So an IRR on a piece of real estate that is under $1 million, a small apartment, a small, a basic home, a small office or something like that, your IRRs ought to be north of 15%. Mine are on almost everything I own that's income producing. And your cash on cash in most cases with a typical piece of real investment property would be 8 to 12%, somewhere in there. Your cash on cash alone would be that. Now, again, on stocks, you got 2 possible places of return. One is the increase in value, and 2 is the 2 is possible dividend payouts, which are profits shared with the owners of the company. And when you're a stockholder, you're an owner of the company, so you could get dividend payout stocks, and you'd have a cash flow with that kind of a thing, and you'd have the increases in value. So in both markets, though, people make the statements that you were making, that it's artificially high, or it's ridiculous, or there's a bubble, or there's no way that supports that, when in reality, there's a few times that that's the case. We had a tech bubble in 1999, the dot-com rage, where people were buying stocks on companies that had never made a profit. So that was ridiculous, obviously, and they shot through the roof. Most of those didn't survive. A few name brands that are household names did survive, like, for instance, Amazon. And so, but by and large, the stock market overall is never overpriced over the scope of time. There may be a moment in time that it is, or there may be a moment in time that it's underpriced. I'll give you an example. You remember the oil glut, because the ships were all parked off the shores because nobody was driving, and oil went down to $0 a barrel, or sub-zero a barrel, about 5 weeks ago. Do you remember that?
Yes.
Okay. And so that drove Exxon's stock way down. It was artificially low because it was a temporary situation. So the numbers didn't justify how low it was. Other times something hypes up and the numbers are artificially high. But over the scope of time, they generally correct back and forth. And, you know, you can look at PE ratios, profit to earnings ratios, and you can look at the book value of the company, the assets that they own, and compare that to the stock prices and the outstanding shares. And, you know, most of this stuff's pretty close. To say that the Dow's at 30,000 and it just cannot maintain. Why? Because you emotionally can't accept it? When the math is actually there? That's absurd. So that's like saying, you know, this piece of real estate is never worth this. Well, the rents coming in off of it actually say it is worth that. And so, you know, I'm looking at a cap rate on my NOI, my net operating income on this piece of real estate says it is worth that. And so, and 7 people right around it have just paid similar prices for that. So yeah, it is probably worth that. Just because, you know, when I was a boy, that piece of property sold for, you know, 100 times less does not mean that it's not worth that today, just because I can't emotionally keep up with the prices. There's math on all of it. Now, again, there's examples of individual companies on stocks or individual pieces of real estate where they are overpriced or where they are underpriced. But by and large, you have a better chance of sneaking up on a deal with a piece of real estate. I like real estate. I've got a bunch